Nifty Midcap 150 Index Fund, NFO. Will this fund help you create long-term wealth? Who can invest in this fund? Who should avoid this fund strictly? Let us explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions. Before evaluating this NFO, we have to understand the basic structure of this fund, and also we have to understand the strategy of this fund so that we can analyze and evaluate this fund. The NFO is on Navi Nifty Midcap 150 Index Fund. This fund will simply mirror and replicate Nifty Midcap 150 Index in the same weightage given in the index. The NFO is open till 2nd March 2022. The minimum investment to invest in this fund is just 500 rupees. And it is an open-ended fund. There is no entry and exit load for this fund. This fund will exactly have the same 150 stocks as of Nifty Midcap 150 Index. They will replicate the same weightage given in the index. So their idea is to generate similar return as of index subject to tracking error and expense ratio. There are some key facts which we should know about this fund and this index. This index constitutes 150 companies. Top 100 companies are large cap companies. Next 150 companies are part of this Nifty Midcap 150 index. This will have mid-cap companies. This will have 150 companies, and the index will be rebalanced semi-annually. This fund got diversified across multiple sectors. This particular index has got 16% weightage to financial services, also spread across consumer goods, industrial, manufacturing, automobile, IT, chemicals, pharma. So it is completely diversified portfolio. What's the return this index has delivered in the past? In the last 1 year, this index has delivered 46% return. Past performance is no guarantee for future returns, however. Last 5-year return is 18.68%. Since inception, this fund has delivered 17.02% return. Yeah, return wise, this fund has delivered inflation beating return in the past. Top 10 constituents of this fund. What are the top 10 companies of this index? Is Adani, Tata Power, SRF, AU Small Finance Bank, Voltas, C Entertainment, Tata ELXI, Mindtree, Emphasis, Crompton Greaves. So these are the top 10 weightage in this particular index. As we have understood the basic structure and strategy of this fund, we are well equipped to evaluate this fund. This fund is going to simply mirror the Nifty 150 mid-cap index. So 150 mid-cap companies in the same weightage will be invested. In the past, this fund has delivered inflation beating returns in the long run. Remember, the long run means always 7 years plus. When we evaluated this fund, when we did our research, what are all the key observations which are in favor of this fund? That we will see first. As I told you, this has got a very diversified portfolio across multiple sectors. This fund is actually suitable for aggressive investors who are looking for mid-cap exposure. This fund is free from fund manager bias. Fund manager selects a stock and it is going to not do well. It is a risk, no stock selection risk. This fund eliminates the stock selection risk because here the fund manager is not going to analyze the stock, pick and choose a best mid-cap stock. No, he is going to buy the entire index without analyzing anything. So there is no fund manager bias. This fund eliminates the the stock selection risk. Long-term investments in this index fund have got potential to give you capital appreciation. Yes, we have seen, provided if you are investing for long-term 7-year plus, this fund can deliver inflation-beating returns. As this fund is managed passively, this is expected to have low expense ratio because there is no fund management expenses. So obviously this will have low expense ratio. As this fund is going to invest only in mid-cap stocks, which will be highly volatile, less stable. So this makes this fund not suitable for conservative investors. Yes, we have moved from pros, advantages, we have moved to cons. So the first disadvantage is not suitable for conservative investors. Then, being an index fund, because of some factors, this can underperform the benchmark index, which is Nifty Midcap index. Why? Like it is underperforming index, reasons like trading cost, expense ratio, and tracking error. Because of that, this fund can underperform the respective index. We have to understand. As it is going to simply mirror the mid-cap market, mid-cap index, this fund is not capable of generating market-beating returns. This fund will not generate any alpha. This particular fund is going to mirror the index, whereas in an actively managed mid-cap fund, the fund manager will pick and choose the best of the mid-cap stocks. In an actively managed mid-cap fund, out of this 150 mid-cap stocks, the fund manager will cherry pick. Whereas in this particular fund, they are going to buy the entire 150 stocks. Whereas in the actively managed mid-cap fund, the fund manager can cherry pick the best stocks. Because of that, they will be able to outbeat the index. Here, they are not going to outbeat, they are going to simply mirror the index. So no market beating returns here. The fund manager will not be able to change the allocation based on the outlook. We have seen this fund has got close to 16% allocation to financial services. Suppose the outlook for financial services becomes worse and the outlook for information technology becomes better, will this fund move the allocation from financial services sector to IT sector? No, it is not possible. Whereas in the actively managed mid-cap fund, it is possible. Whereas in this Navi Nifty Midcap 150 index fund, which is passively managed, it is not possible for them to dynamically manage, change the allocation. It is not possible. Here, the fund manager will not do any analysis on the underlying stocks. He will not look at the balance sheet. He will not look at the profitability. He will not look at the soundness. He will not look at the sustainability. He will blindly buy the entire index. Active funds can take calculated risk. They will analyze the balance sheet. They will look at the soundness, sustainability, whether this company will be there after 10 years, 15 years, 25 years. Based on that, in the active fund, the fund manager can take a well calculated risk compared to this passively managed index fund. Then tracking error is another major drawback of any index fund. So this is also a drawback of this particular fund. Normally in an actively managed fund, the fund manager can definitely take course corrective measure after market correction or market crash. If there is a momentary opportunity in the market in particular sector or in particular stock, they will be able to encash. As we have looked at the basic structure of this fund, strategy of this fund, also we have analyzed the key findings based on the analysis, pros and cons of this fund we have analyzed in detail. Now is the time to answer the final question. Do we have to invest in this fund or do we have to avoid this fund? It depends upon what kind of investor are you. What do you already have in your existing portfolio? Based on that, it has to be decided. If you are an aggressive investor who is not at all willing to invest in an actively managed fund, then in that case, this fund may be suitable to you. Yes, first you should be an aggressive investor, and selecting an actively managed fund is not part of your circle of competence. Then in that case, this fund may be suitable to you. For investors looking for large cap or small cap exposure as well, this fund is not suitable. You already have mid cap exposure in your portfolio. You are looking for only large cap, or you are looking for only small cap exposure. Then this fund is obviously not suitable for you. In an actively managed mid cap fund, they will cherry pick the best mid cap stocks out of this 150 and construct a portfolio. Right? So an actively managed mid cap fund has got higher potential to outbeat this fund. Whereas this fund simply blindly buys the entire index. This fund is not analyzing and cherry picking the best stocks from the index. No. So actively managed funds have got higher potential to deliver better returns. Even if you're an aggressive investor who would like to invest in passive mid-cap fund, there are existing mid-cap index funds which are already maintaining less expense ratio and less tracking error, whereas this fund is considered the ability to maintain the low expense ratio and less tracking error is not tested. So we have to wait and see. Because this fund is investing only in the index, it is not possible for this fund to generate alpha. They will not be able to beat index. So if you are looking for market beating returns, then this fund is not suitable for you. Anyway, before deciding, consult your financial planner so that whether to invest in this fund, whether to avoid this fund, based on your customized financial plan, he will be able to suggest. We have done a detailed analysis of this fund. Complete research of this fund is available as a blog post in our website. You can go through the blog post in the link given in the description. Do you have any questions on this NFO or any other investment options? Feel free to book a free appointment with our financial planner. The registration link for booking a free appointment is given below this video in the description box. Would you like to attend insightful investment webinars? Then in that case, we are there for you. Yes, we organize regular investment webinars which are insightful to create long-term wealth, and it is completely free. The registration link for our upcoming webinar is given below this video. Last but not the least, if you have any friends to whom this video will be of use, please share it with them. If you have not subscribed to our channel so far, please subscribe to our channel so that you will not miss any of our future videos. Not but not the least, if this video has added value to you and you like this video, please give a thumbs up. Bye. Thank you.